Well, I think the blip does, probably closer to that than this bird box scenario that we're all talking about of late. I mean, I think the progression in fear has been alarming. The spillover into price action in risk assets has been alarming. But you had a very healthy patient going in, so I think we can withstand some of that. I think the proper actions here are helping investors think about where they are in the progression from the infection phase to the containment phase. And certain countries are well ahead of us in that. And so there might be some opportunities in places like emerging markets for risk-seeking investors. I think it's, if you think about how we allocate assets, we use a concept that we call price cost averaging, Scott, which is dollar cost averaging with accelerations on price declines, right? And so how are we looking at the uncertainty created by this? Well, we're buying, but we're very measured and methodical in the way that we're doing it. So if we would normally fund at 25% on a 5% pullback, we're maybe doing 12%. So it's a much more measured pace.
Okay. So Rob's not alone, right? Tony Dwyer today, who was in our piece there, is maintaining his 34.40 year-end target. Deutsche Bank is maintaining their year-end target of 32.50. Goldman says zero earnings growth somehow keeps its target of 3,400. Bank of America says 28.80 to 30.40. Citibank says transitory shock, no recession, rebound coming in the second half. JP Morgan says large but temporary and maintaining overweight for U.S. stocks. Kudlow, we'll get through this within months. Steph, who's right?
I mean, targets are silly at this point, right? Because we don't even know what the economic impact is going to be.
But the targets reflect a view. And the view is more, I mean, not even more. It's overwhelmingly blip. Like these people and Rob and Joe, by the virtue of how he's buying, thinks this is just going to be a blip.
Well, I do too. It could last, though, longer than expected. That's the whole reason why having a long-term target by the end of the year is really silly in my view, because you just have no idea. Again, as I said, the economic impact, the earnings impact, we just don't know. We're not going to really see stabilization, I don't think, until you get enough tests in the system, which seems to be 4 million by the end of next week. And then you're going to get the real numbers. And then that's probably not until the following week. So maybe you have volatility for the next couple of weeks, because, again, it's not just the virus, but it is the economic impact, it's the earnings impact and all of that. But I think you have to get the real numbers for people to start to calm down so that we can actually start to model and going forward. That said, the stocks there are so many stocks that are down 20, 30%. Blue chip quality, #1 in their industry with phenomenal balance sheets. I just have a hard time not putting 1 to 2% of cash to work a day. I can't time it, Scott, but I can dollar cost average. If I buy low some days, that's great. If I buy a little higher, that's okay too. They're all going to go down. I'm trying to do relative investing at this point, the things that are going to go down the least. And the ones that are down the most seem to me like the biggest bargains.
So I came into the business during the first Gulf War, and I remember going over to someone and saying, this is what I think is going to happen. And they shot back at me quickly. No one cares what you think. Observe and react. And I think right now, observing and reacting what's going on in the marketplace right now, no one's selling their passive investments. No one's selling their private equity. No one's selling their house. Market house down 10%, America. Doesn't mean you're going to go and sell it. So this is more of a trading environment than anything else. And the observation that is so important to me is the fixed income market and how the Treasury market is trading and the relationship between Treasuries and equities. Right now, the Treasury market has become a speculative playground. That's unequivocally what's going on right now. You've got 40 basis points lower in the course of 36 hours. Think about that for a second. Heavy speculation, whether it's on the part of sovereign wealth funds, global central banks, individual speculators, you name it. Negative rates. We now have to think about the consequences of negative rates in this country. We are not ready for that. The IRS is not ready for that. We're not ready for interest income becomes an interest expense. Let me just finish the last point on that. Think about that.
Because I want to take issue with something you said. So finish up.
So think about this for 1 second. What does the Treasury market need more than anything else right now? It needs a seller. The best thing that could happen for the market is we see a 10-year Treasury print, 1.25. We need a seller in the Treasury market. I know this sounds counterintuitive. We're talking about Federal Reserve rate cuts. The best thing the Federal Reserve can do right now is stand up and sell Treasuries and force yields higher.
Okay, so Joe just declared this, quote, a trading environment. Steph, I come back to you because you've suggested that it's anything but that.
Well, I'm not
that
good
it is
at
a
that.
long-term, this is an investor's market. Because as you said, stocks are down 20 to 30%.
Some,
well,
sure.
but the ones you're talking about, you're
absolutely.
talking about the way I think a lot of our viewers are thinking about.
Yeah.
You're looking at the way that some of these stocks have come down, and you're saying that these are great if you're a long-term investor because these are bargains that you may never see again. Well, so who's right? Trading market, trading environment, or is this a time to pick off stocks for the next 5, 10, 15, 20 years?
Well, you could day trade if that's what you're into, if that's what you're good at. I'm not good at that. I know what I'm good at, and that's picking good fundamental companies. I've done a lot of analysis on the blue chips of all blue chips in each sector. And I'm trying to be diversified, and I'm just trying to say, where does it seem irrational to me? So while I don't have a long-term S&P 500 target, I do know in 12 months from now that United Healthcare is going to be higher, AbbVie is going to be higher, CVS is going to be higher, Caterpillar is going to be higher. Because there's no doubt in my mind that these dividend yields are getting to extremes, and the action is absolutely at extremes. So to me, that's why I'm picking, because I do have a longer-term frame.
All right. The reform broker, the TRB. You've listened to this. Now, what do you think, based on what you've heard this week from the esteemed people who've been on our program and this desk?
Well, a lot of very intelligent things have been said. And, you know, I think the bigger picture, though, and the thing that should matter to most viewers is that what we're witnessing right now is a triumph for diversified portfolios. Take a look at what. So if you're watching me right now, and I know I'm very handsome, but try to think about what your allocation is. Don't get distracted. Probably you're somewhere around 50-50 equities and fixed income, if you have a financial advisor who's thinking of your best interests. That portfolio, if it's U.S.-only stocks and U.S. bonds, you're down 1.46% on the year. You're not even down 2% year to date.
So right.
You're definitely not jumping out a window. To Joe's point, you're not packing up the family on a wagon and moving out west. Even if you did that 70-30, if you're under 65 and you're watching me right now, thank you for watching. A 70-30 portfolio year to date is down 4.36%. You're down less than 5%. We had a negative 5% year for the S&P 2 years ago. So this morning, the VIX hit 50. First time since the trade war peak in February of 2018. We had a quick recovery from that, but we weren't back to the new highs machine. We had 18 months of go nowhere. That is another possibility. It doesn't have to be plunged to zero or Dow 30,000. We can be in this in-between place for a long time. Now, Rob said something really smart about, I know you're trying to get in, but I'm going to say what you were going to say anyway. Okay. Rob said something about international diversification. Dead on. I want you to focus on this. Since the S&P hit an all-time high 12 sessions ago, it has underperformed international stocks substantially. The ACWX, which is All Country World Index, ex-US, is outperforming the S&P by 270 basis points. And the EEM, shocker, emerging markets where the crisis is most acute, right now outperforming by 330 basis points. So diversification is triumphing right now. Your bonds went up big. Anything fixed income, the stuff with a yield barely fell. Utilities down 5%, big deal. And if you had international stocks, it cushioned the blow. So if you look at your portfolio now, you're not freaking out. You're saying, okay, this sucks. I thought I was going to make money every week. Well, this week you didn't. Sorry.
That's absolutely great commentary.